Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Neal Desai. He is CEO of Caffeine, and we are going to discuss lease-to-own products. It is great to have you with us, Neal. Welcome to Trade Talks.
Thank you. Delighted to be here.
Tell us more about Caffeine and the types of products that you're providing.
Yeah, absolutely. So Caffeine works with retailers to be able to provide flexible financing to consumers that are traditionally locked out of traditional credit. Okay? Let me unpack that a little bit. You can imagine a consumer whose refrigerator breaks. That consumer walks to an appliance store, selects something, and that appliance, that new refrigerator, may cost a couple $1,000s. Now, what people don't realize is that there are over 100 million Americans who don't have access to credit cards or sufficient credit capacity. What Caffeine does is partner with that appliance store and that consumer to be able to offer the financing required to purchase that refrigerator, and it does so in a very flexible way.
How is this different than buy now, pay later?
There are some key differences. The first one is that a traditional buy now, pay later is on the order of several $100s. And if you think about an appliance or furniture or tire and wheel, the types of categories that Caffeine focuses on, a couple $100s isn't going to solve the need. Our standard approvals are several $1,000s, so there's a capacity difference. The second major issue is that lease-to-own is typically associated with categories that are needs rather than wants. So we don't finance things like beauty or travel or those types of items. It's really big, durable stuff that a consumer needs to run their day-to-day life. The final difference, and I would argue one of the most important differences, is that buy now, pay later is a convenient form of debt delivery, meaning that the consumer, when they do a buy now, pay later product, is engaged in a form of debt, whether or not there's interest. The interest is typically paid by the retailer. Lease-to-own is flexible in that it's not debt. The consumer can cancel at any time if they either choose to or if they have difficulty making their payments. And because of that cancellation flexibility, for the demographic that is typically underserved by credit, they need flexibility the most, and the product has that flexibility built in.
Are there downsides to lease-to-own?
There are trade-offs, right?
Because you got to make money somehow. So you're either marking something up or charging fees.
Yeah, I think the key element that's often misunderstood with lease-to-own is it has this perceived high price. When you actually run it out and you look at all the built-in flexibility as well as all of the discounts in the product, what people find astonishing is that most of the time it's cheaper than a credit card. Okay? So although people think that the product may have some disadvantages, I would argue the product is in many ways strictly superior to any kind of debt financing that you will be able to find if you're in this demographic. I'm a huge proponent of the program, and I believe we're going to see significant expansion of lease-to-own up and down the credit spectrum over time.
Which is interesting because should we go into a recession, it sounds as if these aren't discretionary items. These are items that you need, to your point earlier, to function in your home. So it almost sounds as if it could be recession-proof as well.
Yeah, our business is highly countercyclical. And when I say that, what I mean is that both demand for the financing is relatively resistant to recessions. Refrigerators still break, recession or not, right? So demand is resilient, and consumers will prioritize their repayment of this type of asset over some of their discretionary spend. You're starting to see that in the market, right? You're starting to see some buy now, pay later providers, some traditional unsecured credit providers indicate that there's stress on their portfolios. The lease-to-own space, and in particular Caffeine, we're not seeing that stress. Consumers' balance sheets are still pretty strong, and they're prioritizing our payments over unsecured payments.
How has technology made underwriting more efficient?
Lease-to-own in the current form could not exist without the technological advances we've seen over the last 10 to 15 years. To put this in perspective, traditional credit providers will oftentimes underwrite a consumer using one data point. What is their credit score? 700 plus? Sure, I'll approve. Below 700, pass. We use 20,000 data points to be able to underwrite our consumers efficiently, because that's how hard it is once you understand that credit scores are not indicative of repayment performance when you get below 680. 680 being the median credit score in this country. So without the technology required to process 20,000 attributes in a given series of milliseconds, which is what's required at the point of sale, that undergirds and supports our entire infrastructure.
So then you'll take into account if you're paying your cell phone bill on time, Netflix bill on time, the month-to-month things that have to be paid.
That's right. Consumers get credit for things like utility payments and subscription payments, whereas traditional credit providers are not going to consider those types of payment behaviors.
And you just raised $18 million in a Series B round. Explain to us what those proceeds are going to allow the company to do, and what was it like, going through a round in today's environment?
Yeah, the process of raising capital is something that I typically enjoy, right? And look, let's all acknowledge that the macro environment has gotten more difficult. But for our sector and our company specifically, the fundamentals are really strong. As we indicated earlier, this is a counter-cyclical business with very good unit economics. We're also starting to see some of the competition pull back. The buy now, pay later guys are contracting. Traditional credit providers are contracting. And that leaves open space for us to expand into. So when we raised this capital, it was really from a position of using the capital to expand and take advantage of the increasing opportunity set before us. How we're going to do that, we're specifically going to use the capital in order to partner with more retailers, offer the product to more consumers, and most importantly, hire top-tier talent. We've seen that about half of companies out there have already laid off staff or are considering it. We are starting to see real opportunity to pick up highly talented individuals who are mission-driven, who want to join a company that's growing and fundamentally strong.
Yeah, it's interesting to see how you're taking advantages of all these different displacements in the marketplace. Neal, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.